Last week, we looked at job order costing, and we did in that PowerPoint, we looked at the basics of overhead. So let's look at overhead in a little more detail. So we know that job order costing includes the direct materials, the direct labor, and the applied overhead for any particular job is what makes up the total cost of that particular job. So when we keep track of that job, we fill out a job cost sheet with those things on the job cost sheet. And the direct materials that goes on to that job cost sheet for that job is from what materials we issued on the materials requisition. So when the guys on the factory floor need something to start the next job, they send a materials requisition form that says, this is what we need. The materials storeroom manager is going to get those materials ready and get them forklifted or whatever, delivered over to the factory floor. Some of those materials will be indirect materials like glue or nails or things like that will, in the bookkeeping, even though physically they're going over the factory floor, the bookkeeping will put them into the overhead account. The direct materials go on the job cost sheet, bookkeeping wise, and into the work in process account. Direct labor is shown from a timesheet analysis. So all the people that work in the factory, they have to keep track of their time and what job they're working on, so that we know how many hours go on to every job. Now, the direct labor, of course, are the guys who are actually working on building whatever the job is, and the indirect labor is going to come off the timesheet analysis and go into overhead as a debit. The direct labor will go into work in process and onto the job cost sheet. Overhead on the debit side is the actual overhead, which includes the indirect materials, the indirect labor that we just talked about, along with other factory-related costs, such as insurance on the factory building, repairs for factory equipment, utilities for the factory building, etc., are added onto the debit side of overhead. But overhead is applied to the job, and then we're going to credit overhead. That's when we're applying it. We're going to use a formula to do that. Otherwise, some months we have a lot of overhead, and other months we have very little overhead. And so even if we had a job in August that's the same as a job in September, they might have two different overhead amounts applied to them simply because one month had more actual overhead coming into it. So rather than do that, we use a formula, and we use that formula the entire year. Here's our example of our job cost sheet. This was job number 101. We started on March 6th. We finished it on March 19th. This was a TV cabinet. And here's our direct materials, and they're all listed down. Our direct labor for this particular job, both the direct labor hours and the dollar gross wages amount, and the manufacturing overhead that we applied. Now, we're going to apply overhead at the end of every month. So at the end, this was the month of March, so at the end of March, or on March 19th when the job was done, we count up the hours, the direct labor hours for that month, which was 22.4. We put that there, and we multiply that by what that formula rate is, okay, that we figured out last fall, and now we're using that same $12.50 rate all year this year. So we take the 22.4 times the $12.50, that gives us $280 that we are applying of overhead to this job for this month. Now, since the job is done in the same month, we total up the direct materials, direct labor, and that applied overhead, and that gives us the grand total of what this job cost us to build. Obviously, we will charge Robin Gray, the customer, more than this because we have to make a profit on top of our cost. So how do we get that $12.50 rate? Well, we have all the actual overhead, and that includes, as we said, indirect materials, indirect labor, other factory-related costs such as property taxes, insurance, equipment repairs, and plant utilities, things like that, all go on the debit side. Now, to be able to come up with the formula ahead of time, though, means I'm going to have to estimate all of those types of costs. So, all of the actual costs for those things from 2020 will then start the basis of estimating how much we think we're going to need for those things for 2021. And the actual overhead costs are debited to overhead, as we said before, and we apply or allocate based on the formula. We're going to credit what we apply to the overhead account. So here just shows us a journal entry. We're going to debit overhead for anything that is the actual overhead, and we're going to credit either accounts payable if we purchased on account, such as like the factory utilities. Now, if they're the utilities for the office building, then we're going to debit utilities expense, credit, say, accounts payable. But if it's utilities for the factory, we debit instead manufacturing overhead and credit accounts payable. Now, this is showing you like it's one giant amount for the whole year, but really there'll be a zillion small things that we debit overhead and credit accounts payable or cash all during the year. But at the end, we're going to know how much we spent last year, and we're going to use those to estimate how much we're going to spend next year for our formula. Now, this also talks about the allocation base, which is also called a cost driver, and we have to determine that before we can do the formula as well. So we might use the number of units produced if we're a real small company and we only make one kind of thing or something. We might use the number of direct labor hours. That's a real common one to use, particularly in companies that basically have a lot of human direct labor. Some companies have a lot of machines and robotics and stuff that's making the stuff, so they might use the number of machine hours instead. Okay? And there can be a lot of other different cost drivers. It's up to management of the company to determine what cost driver they're going to use. Okay? And then to get that overhead rate, we're going to take our estimate of the total actual overhead we think we're going to spend next year, divided by the total of the cost driver that we think we're going to have for next year. And that's going to give us this one predetermined overhead rate. And we'll use that rate from January 1st to December 31st of next year, that same rate. Okay, so that is our plant-wide rate. We'll use that to allocate or apply overhead to all the products for next year. We usually calculate this rate in the fall, and then we'll start using it next year. However, we can have separate overhead rates for separate departments or separate processes or separate activities. Okay, and we'll have a different slideshow for the ABC costing overhead, which is in Chapter 5. Okay, here we talk about using estimates, why we use estimates, and this is a repeat of last week's PowerPoint. And again, the predetermined overhead rate, the estimated overhead cost divided by the estimated amount of the cost driver that we're going to have for next year. Okay? Okay, here's an example. Assume that the company has $100,000 they estimate they're going to have in total actual overhead costs for next year, and they estimate that they're going to have 8,000 direct labor hours. Okay, so their estimated overhead divided by their estimated cost driver. So the 100,000 divided by the 8,000, that gives us the predetermined overhead rate of $12.50 per direct labor hour. And then we'll use that same $12.50 all next year. So if a job like the one we looked at required 22.4 direct labor hours that particular month, we multiplied it by the rate of the $12.50 and we got $280 of overhead. Okay. Now, this takes a look at, okay, our estimated overhead, our estimated cost driver, and our predetermined overhead rate. What if they actually had 8,100 of direct labor hours during the year instead of the 8,000 that they thought that they would have? Okay, then we would end up having applied overhead. We would have applied it based on how many direct labor hours we actually had that year. Just like with the 22.4, we would have taken the actual direct labor hours for each job and multiplied it by $12.50. So by the end of the year, we would have multiplied 8,100 times the $12.50. So that would have given us a total that we applied of overhead of $101,250. So in the end, of course, this would have been piece by piece during the year. So they show it as if it's one giant journal entry at the end of the year, but actually every job, every month, we would have debited work in process and credited overhead for the amount that we applied, such as that job cost sheet that we looked at that was the 22.4 direct labor hours and $280 of overhead that was applied to that job. We would have debited work in process and credited overhead for that $280 back in March. We don't have just one giant one, but this is just showing you that the total by the end of the year that got debited to work in process was $101,250 and credited to overhead is the $101,250. Now, if we have different products, then we can figure out separate, different overhead rates depending on those different products. And we'll discuss that in our next